Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. If you haven't done so already, go check out hardmoneymastermind.com. It's new and improved. We consolidated a number of different websites into one, so you can do everything that you need and see everything that we're up to right there, hardmoneymastermind.com. Okay. Talking about, have we changed underwriting? As we're recording this, it's early March 2025. And as most people know, there have been a lot of changes happening in the federal government. We are from the DC metro area. We grew up in Rockville, Maryland. Our office is in Columbia, Maryland, halfway in between DC and Baltimore. And this has always been our home lending market. We've expanded over the years to some other areas of the mid-Atlantic, but this is where we have our most exposure. DC, Maryland, Virginia, DC metro, right? And in case you pay attention to the news at all this year, there's a lot of stuff happening with the federal government. Basically, every agency is being scrutinized, cut down, some of them even shut down entirely by this new office of government called DOGE, the Department of Government Efficiency, run by Elon Musk. And in addition to the government agencies, there are also tons of contractors around the DC area. Many of them you've heard of, right? Booz Allen, Northrop Grumman, a lot of big ones, defense contractors, and many, many, many of them that you've never heard of. And they're all in some ways tied to government contracts. And when those contracts get cut, there are a lot of people both in the public sector and the private sector out of work. And how is that going to impact the real estate market? Now, you've probably seen some stuff going around Instagram and other social media. I know I have, that says like half of Fairfax County, Virginia is listed for sale. And like, you know, it's just, clickbait really. So far, that hasn't happened. Not half of the DC metro area is for sale and everyone's bailing and out of work. That's not the case. Does that happen? We'll see. And in terms of how it's going to affect our underwriting, we're going to dive into that today.
Yeah, I mean, I think this is a common question that comes up from local lenders and from lenders out of state. It's like, hey, are you concerned? How is this affecting your underwriting? Are you changing anything up? And, I think the short answer, we're going to get into the long answer here in a second, but the short answer is it's actually not changing our underwriting. And the reason it's not is we believe that we underwrite pretty conservatively from the beginning. And if anything did happen with the economy, the markets, national disasters, anything that comes up, I still think that the way that our loans are structured, that we're protected. Now, if the market depreciates, declines, crashes 50% overnight, we're not fully protected on that. But I think that in general, we're conservative on our after repair values. We're conservative on our as is values. We're conservative on who we lend to. We make sure the borrowers have a lot of skin into the deal. And overall, I think we're in a comfortable spot. Now, I know lots of lenders out there are definitely nervous, institutional backed lenders and private capital lenders, but it's mostly because their loans aren't very conservative to begin with. They're lending 100%, 100% of the as is value, 100% of the after repair value, 100% of construction. Some of the borrowers are qualified, some of the borrowers aren't qualified. And, a lot of them are lending based off of a third party appraisal. They may or may not know the areas, and they're just not, they're trying to ride this wave that has occurred for the last decade, maybe even more, of an appreciating real estate market. And I don't know, maybe we're just a little bit more cautious in nature. Maybe we were around during, 07, 08, 06, 07, 08. We had started investing in real estate, and, we're in the mortgage business kind of in early to mid 2000s. And we kind of saw how things shaked up, and it didn't really impact us majorly. And we started our business in 2007. So I guess we saw, how low some of these property values went, and, how quickly they rised. And I think there's just a lot of capital that jumped into the space, and they've ridden the wave. And let's be honest, like, if you wrote a loan in the last 10 years, and even if you weren't all that cautious, it still probably worked out, right? Because the property value is appreciated. And you never really even learned if it was a good deal or a bad deal because it performed and you just assumed it was a good deal. So we've been overly cautious. I think we've left potentially a lot of money on the table over the last decade compared to some other lenders that have just done significantly more volume than us. And so be it. You know, we could sleep well at night knowing the loans that we did. So to answer the question, we haven't really changed. We haven't really changed much because the borrowers are still bringing minimum 20% down to the table. Now that's minimum. That's assuming that they buy like a home run deal. You know, a lot of the loans that we do, the borrowers are bringing 35 or 40% of their own cash into the deal. And I know that might sound crazy, but that's just what it is. That's just how we're comfortable structuring loans. You know, I was literally looking at 2 deals today, and I'm trying to figure out ways to make these deals work, to help this borrower work because they just need so much darn cash, and we're just misaligned on what the purchase prices are. They think they're buying good deals, and they probably are. And they're at like a $600,000 ARV, and I'm at like a $400,000 ARV. And you know, it's the difference between them bringing like $180,000 to the table, which is where we're at now, to them wanting to bring about $100,000 to the table. And coincidentally, that one of these deals is in DC. But it's funny because I don't feel that I'm more conservative because it's DC. I feel that I'm conservative because that's the nature of, hey, like I want to be safe on this particular deal. And it has nothing to do with, DOGE or if there's markets changing.
Yeah, that's interesting that you brought up 2008 in this one. And that's a good point too, because I don't know if you remember. So when things were getting during the foreclosure boom, subprime crisis, all of that started in maybe 2007 and then got bad in 08 and 09. Do you remember what people said about the DC area and why it would be resilient?
That it's insulated. It's insulated and it never changes, right? Because of
By
DC
the
government.
The job market. Yeah, and some of that has to do with government. Some of that has to do with private industry. But a lot of that is somewhat government connected. And that didn't really play out the way some people thought. Some people said that because the job market is so strong and people have to be around here, that DC is going to do better than other markets in a crash. And it did do better than other markets in a crash. That doesn't mean it was immune. There was still, like, when we were starting HMB and getting out of the mortgage business, like there's a lot of doom and gloom around. There's a lot of foreclosures going on depending on what area of DC Metro you're in. Yeah, there was a lot of wild stuff, fire sales, short sales, everything else. And that was with that job market intact. And so now we're looking at a different animal, because if you take away the strength of DC's job market, how good is our market? No one knows. Hard to say. How much is this going to affect? Like, how many people in the population? I don't have the answers to this. Is this really going to affect? So a couple answers to the initial question. One, this came in from a local investor who emailed us. She's a fan of the show. We appreciate it. Asked about this, and we've discussed it, of course, but we just haven't done a show on it yet. And yes, one of the answers, like Jason said, is that we're kind of always underwriting for a dip in the market, and we very well know that we leave money on the table by underwriting that way. We do. And then the other answer to the question is, yeah, of course, we're still watching it. Of course, we're still watching what's going on. In these counties around suburban Maryland and Northern Virginia. Who knows? Are we going to see some more softening? It could definitely happen. We're going into the spring market. Like, Montgomery County should be good. Loudoun, Fairfax, Arlington County, PG County. But is it going to play out that way? I guess we'll see.
Let me add to the we're always watching. One of the best parts about this investment vehicle in business is you can determine how much you want to lend based on your comfort level of what's going on, not only externally, but also internally. Like, hey, I have 3 loans in this neighborhood. I don't know if I want additional exposure. Or, here's one that I like to always think about. Someone could come to us with the exact same deal and we could quote them a different amount depending on the day, the mood, anything, right? So like today, as we're recording this podcast, I could get a deal in DC that I think is worth about 400,000 ARV, and we're going to lend them 260 with a $60,000 holdback, and it's 200 towards purchase, 60 towards construction, and they need, I don't know, $90,000 cash to close, $100,000 cash to close, right? That could happen today. Tomorrow, that exact deal might come, and the terms change. Like we might be, more aggressive or less aggressive. Might be like, you know what? Maybe we'll do 270 with with a $60,000 holdback, or maybe we'll do 250 or 240 with a holdback, and they need more cash. Like, it just depends on all that. So we're tracking all those things, and the beauty of being a lender sometimes compared to being a real estate investor is you just see so many darn deals. Being a real estate investor, yeah, you're involved in some deals, but not nearly as as the lender. I mean, we've looked at hundreds of thousands of deals over the last 17 years, just from of what's out there, and if you're listening and you've been lending long enough, you've probably even been in a situation where different borrowers brought you the same deal. There's a property in your neighborhood, or there's a hot property on the market in your market, and multiple people are trying to bid on it. And it's interesting to see what purchase price they're willing to bid on it at, and what's their construction budget, right? Because that changes based on who they are. So you get to see a lot of things. So to sum this up, no drastic change, but it's definitely, we have our eyes on everything, right? You learn from that stuff. You don't, we're all learning in real time, and that's why we like this business as an owner-operated business, and be on the front lines just to see what's going on. I mean, think about it. Think about after you foreclose on a property, you learn that foreclosure process. It doesn't matter what's taught or what you think is going to be the process. You learn. Like, we know for a fact that there's some states that are so characteristic driven, the collateral's good, but unless the borrower is going to perform, we are going to take a haircut on the deal. And then there's other states that we can foreclose very, very quickly in. Even if the borrower runs into some speed bumps, we're still going to be in a good spot if we have to foreclose, right? You learn that just from experience. So it's important to kind of, pay attention to see what's up. And, as the markets change, as they soften, as we see what's up, right? Like right now, I'm still pulling comps, and a lot of properties in DC are still, selling quickly if they're priced accordingly. Yeah. They're not going to sell quickly if they're not priced accordingly. I mean, that's stupid, right? Like, and that's what's happened in the past. But we're very realistic of what's going on in the markets. We're very realistic what we think exit strategies are. We're very realistic what a good purchase price is. We're very realistic on, hey, based on this type of borrower, with these, credentials, financials, experience, they should be able to perform on this deal. They got a lot to lose if they don't, right? And again, yes, if we do a loan for $200,000 and the property goes down 50% in value in 3 months, are we stuck? Yeah, possibly, but we're also going to hedge that, we're writing a loan on a good property to a good borrower that has lots of skin in the deal, that potentially has more to lose than we do if they decide to walk away or not perform. And, we're comfortable with our underwriting decisions based on, a lot of those elements.
Important question, guys. I'm glad this is asked. We'll address it again in the future. Actually, now that I say that, all right, so we were recording this in March of 2025. Some of the best feedback we get from people when they reach out to us is that they came across our podcasts. It's exactly the kind of stuff related to private lending they wanted to hear, and that they went back and listened to a bunch of past episodes. So we're going to see how this ages. Fast forward a year, if somebody's listening to this in early 2026 and they talk about what we said, or, reach out. In essence, like, if anybody is watching this or listening from the future, let us know how we're doing. And we'll see, time will tell. We do our best. We don't try to predict that much. We're more of like what's going on right now. Like, we're not big on predictions, but we do it here and there. So whatever it may be.
We're always wrong in prediction. We thought the market was going to crash 5 years ago, 10 years ago, yesterday. Like, we're definitely.
Well, eventually we'll be right. If we keep saying the same thing, eventually we'll be right. And that's just the underwriter mentality, the conservative nature with which we approach this business. So anyway, guys, good stuff. Thank you for listening or watching. We appreciate it as always. And until next time, we'll see everyone inside hardmoneymastermind.com.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.